All right, good morning, everybody. I apologize for a little bit of a late start here. We're having difficulties again with the registration process, so I have a little bit of a lighter load. But we will record and email this out to everybody. Just a couple housekeeping items just to remind you, this is a Zoom meeting. It's not a webinar, so you're welcome to turn your video on, but understand that, you know, up to 80 people may be watching you as well. So we do have you muted. We would appreciate if you put any comments or questions in the chat function, and we'll be watching that as we go through the presentation. So again, for those that are coming back, we appreciate you. I saw a lot of continuing emails through the PPP series that we did, so I appreciate you guys coming back along for this. And for those that are new, again, I appreciate you being here. Should have a good presentation for you this morning. So I am pleased to be joined by Chuck Porter this morning. He's one of our directors over in the wealth management area. We had potentially slated this for some time in January. However, with the election, I think it was probably prudent to move it up into December and you know, get this information out sooner than later. So Chuck, good morning. You can kick us off here and we'll get started.
Yeah, thanks, Brent. Good morning, everyone. Yeah, we've got a decent agenda today. Just so you guys are aware, my focus is mainly on individuals over on the wealth management side. That includes some small business owners. And Brent and I do work together quite a bit on client-related matters. So it's often a situation where I'm the idea guy, and I'll bounce it over to Brent, and he will tell me, kind of back me off and tell me what we need to do to make sure that we're in the line. So so we work in tandem in that regard. So anytime that tax legislation comes out, a lot of times it's back and forth between Brent and Mike and the other folks over there to kind of figure out what the best strategies are. So so a lot of my focus will be on the individual side. Brent will be focusing on on some of the more complicated business matters. So we're going to cover today. We're going to talk about the current state of affairs, state of the IRS, the state of the election, and a review of some of the tax laws that have been passed in the past couple of years. And then we're going to get into some potential tax changes with the Biden administration, what has been stated on his website and on other sites, and kind of what we're anticipating might be coming down the road, and how that would relate to planning, tax planning, investment planning, and estate planning as well. And then Brent will finish off with the update on the PPP loan developments. So I know there's a lot of business owners who have been kind of following, and, you know, just as a plug, I've talked with a lot of people. I don't know how any business owner, would be able to navigate some of these waters without someone like Brent. I know he's been working tirelessly to keep up with the changes with the PPP loan programs and the other programs. So I know I speak for a lot of my clients who are appreciating all the hard work that they've been doing to keep up with this stuff. So so Brent, go ahead. The state of the IRS.
Yeah, I see you put that on the agenda. I didn't have it on the agenda. I was going to put this as a value added slide, you know, but now it's part of the price of admission. So we'll just have to work harder going through, I guess. Just really quick, this is kind of a off topic, I guess, for the presentation, but just really quick, the IRS still has millions, literally millions of pieces of unopened mail. They were shut down or off-site pretty much like everybody else, and they were bringing in trailers, and at one time I think they were up to 11. I think they cut that in half, if I'm not mistaken. I think they're down to you know, approximately 5 or 6 million pieces of unopened mail. More on the individual side than the business side. So again, just be prudent. in that you still want to respond. If you do receive a notice and you still want to correspond, you want to do it certified mail and make sure, that you can prove that you responded and everything, because we don't know what's going to happen with these and, timing and stuff. So keep it in mind. Just a little tidbit, the IRS plans a 50% increase in small business audits, which sounds really scary, but if you look and see what they did in 2018, it really wasn't that much. So, they are turning the corner, and they're going to try and ramp that up as well. Two things to keep in mind that I would strongly suggest. They are expanding the identity theft PIN number. And what that is a program that they mail you a separate number that you have to put on your tax return for that tax return to be processed. We all know that people try and commit fraud by filing early with ID theft. They file a tax return and get refunds, and then you go to file and somebody has already filed, and it starts a whole big process. I've been in this identity theft PIN number program for a number of years. I would say 7 or 8 maybe at this point. And it's really great. It gives me peace of mind. They just mail a 6-digit number. And again, that number just has to be included on your return for it to be processed. So I would highly encourage that. You can look on the IRS website, but it's being expanded and should be available in mid-January. Now, off this slide real quick, 2 things. We'll address the potential government shutdown later in the presentation here. And also keep in mind, the IRS is really trying hard to grant relief for penalty and interest due to COVID matters. I've put out guidance. So if you do have a situation, just make sure you talk to your advisor to try and get the penalties and interest relieved. So there should be, again, they're trying to streamline that process. So take advantage of that if you need. So Chuck, back to you.
Yeah, I'm going to talk about the status of the election and how it kind of relates to the Biden tax plan real quick. As I'm sure you're aware, Joe Biden, it seems like he will be elected president, and the Democrats, although lost some seats, should maintain control in the House. The Senate is still up for grabs, and that's the best outcome that the Democrats could hope for would be a split. So if they are able to pick up 2 seats in a runoff election in Georgia, then it would be a 50-50 split in the Senate, with the final deciding vote going to Vice President-elect Kamala Harris. So that's why the race in Georgia is so important. And if they do pick up those 2 seats, really what it means is that the Democrats would have possibly theoretically a quicker or an easier outcome to get some of their the policies passed that they would want to have passed. So what are those policies that they're looking at? Biden had stated day one agenda would be to eliminate the Tax Cuts and Jobs Act, which is strong words. And with picking up 2 seats in Georgia, retroactive tax implementation would be certainly possible, where they would pass tax policy that would be retroactive to the prior year. We've seen that before. Again, although right now I think the conflicting pressures are to raise tax revenue while not hindering the economic recovery post-pandemic. So I'm not I speak for myself, I guess, in saying this. I'm not so sure that retroactive tax implementation would be favorable or that they would take those steps. But it's definitely something that we're keeping an eye on, and that's why so much money has been flowing into the Georgia election. So I can keep a close eye on that. And more recently, there's been a modified focus to folks with 400,000 in income and up as to where those tax increases may come from. So again, there's a lot of stimulus that's come into play. Where's it going to come from? And again, more recently focused has been on those with 400,000 in income and up. But I think there's, generally speaking, it seems like there's going to be pressure to raise tax revenue moving forward.
So to understand the Biden proposals, I just want to go back and really recap the Tax Cuts and Jobs Act. So there's a lot of numbers on these slides here, so relax. I'm not going to read them verbatim. I just want to make a point. I was going to use the highlighter and show off some of my presentation skills, but we had to transfer the presentation over to Chuck because of the technical difficulties we were having. So I'm not sure if Chuck, the point of this slide on the second row, if we can look at that. So the first set of columns is the 2018 rates, which was the Tax Cuts and Jobs Act. The second set of columns was the 2017 tax rates, pre-Tax Cuts and Jobs Act. So if you look at both the tax rates, they went down. So the 15 became 12, 25 became 22, 28 became 24. But so they reduced rates, but they also expanded the brackets. So if you look at the old 15%, it capped out at 75.9 in the second row. If you look, it went up also to 77.4 under the Tax Cuts and Jobs Act. And you can see every row, you know, the 25% was 153. It's now 22% at 165. And here's the big one, or one of the bigger ones, the 28% bracket in the old law was 233 capped for married filing joint. Now it's 24%, and it's all the way up to 315,000. So you were paying basically less tax at a rate, but you were also paying in a expanded bracket, which would again be paying less. And if you look at the bottom, we were at 39.6, which was the top rate. We'll talk about that. 39.6 pretty much today here. That went down to 37%. It's all the way up at 600 now, as opposed to 470 under previous Tax Cuts Jobs Act. So next slide, Chuck. Again, I'm not going to go over all this. The top section is just where the brackets are for this year if you want a reference. The last set of parentheses there is just the potential increase under the Biden plan. But again, the top section is just for your reference, really. The capital gains, I just want to go over that first bullet point, is they changed these with the Tax Cuts and Jobs Act pretty dramatically. And instead of just a certain rate, they've somewhat incorporated it with your income bracket. So capital gains right now, the current law is it's a 0% rate for single and married separate up to 40,000, and it's up to 80,000 for married filing joint and 53.6 for head of household. But let's look at that for a second. So if all your income, if you have 80,000 of income and it's all capital gains right now, you're paying 0%. And we can lump in another 24,800 for married people. So if you have even up to $104,800 of just capital gains income, you're not paying any tax at all. Now, that's not usual, but that's the way that the law is right now, and that's how aggressive it is. And then we have the 15% capital gains rates and the 20% capital gains rates. And again, they're based on income brackets now. So it's a little bit more difficult to know what your rate is, but again, you know, I just want to brush that real quick because we'll get into capital gains a little bit clearer with reviewing the Biden proposal. So yeah, if you want to forward, Chuck, this slide is just really a verbal picture of the previous two slides. I don't, you can see the 2020 column is the Tax Cuts and Jobs Act rate, and you can see 2017 is previous. So again, we can see expanded brackets, higher thresholds to jump to the next bracket. The 2022 column is what is being proposed under the Biden plan with the 400,000 or more emphasis, if you will. So the brackets, as we know, would stay the same. The rates would stay the same under 4, but once you're over 4, you're jumping from, a 35% rate to a 39.6 rate.
Yeah, no,
go ahead.
Yeah, I was gonna say. I mean, I think it's we don't know where it's gonna go, right? And I mean, whether that $400,000 mark stays in place, or they just bag the TCJA altogether. So that's kind of where we're at.
Yeah, and that's exactly what I was going to mention as well. Is, in all fairness, if you will, no matter who or what, at this point, nobody would have a truly dialed in tax plan, because it has to go through all the negotiations and everything else. So right now, again, regardless of who, what, politics, anything to the side, this is what anybody would have, just ideas and what their agenda would be, but what comes out at the end could be different. So okay.
Yeah. Yep.
So next slide real quick. And again, I'm hoping not to spend too much time here, because again, we had thoughts. I don't think, again, in all fairness, when Biden said in one of the debates that his day one agenda would be to get rid of the Tax Cuts and Jobs Act in its entirety, I'm not exactly sure that is the case. But again, we want to look at the Tax Cuts and Jobs Act and understand it. So if we go back and look at some of the IRS statistics here for 2018-19, and you just kind of read this slide, you'll see that a lot of lower income people, the Tax Cuts and Jobs Act was a huge middle class tax cut. You can see that in the first bullet point. People earning between 50 and 100,000 saw their average tax liability drop by over 13% between 17 and 18. 17 being the last of the previous again, and 2018 being the first of the Tax Cuts and Jobs Act. People with over $1 million saw a tax cut as well, but it was only 5.8%. And I just put PA there. We're pretty much national average at 13% decrease, but a 3.1% decrease for over $1 million respectively. The Tax Cuts and Jobs Act also repealed the individual mandate. That was all over the news. That imposed up to a $2,000 penalty on households that didn't purchase the government health care, and 5 million people paid that in 17. 75% of those households earn less than $75,000. So that was really punishing lower income. There were pro-growth reforms. We saw that, in the economy. Unemployment was really low. So again, the median household income rose. In 3 years, it rose by over $6,000. Whereas 1999 to 2016, it rose only $257. So again, not that the Tax Cuts and Jobs Act did it all, but it was certainly a part of the economy that we had going prior to the pandemic. So again, if we wipe it out in its entirety, I think it would be prudent just to understand what it did accomplish. So, okay. But again, I don't think that is the case, in all fairness, but I think we need to just address it like that. So, Chuck, do you want to talk about the Secure Act?
Yeah, yep. And again, and I would agree. I mean, I think it's important to understand kind of where we were because we were in a very favorable environment from a tax standpoint. The corporate tax rate being reduced from 28 to 21% certainly had an impact on the market. And again, that's my part of this thing is the investment side. And overall, there were significant reductions in tax. Just looking at the brackets and things. So you kind of go from that to an environment where we've got a big stimulus to pay for. There's definitely pressure there. So as we kind of look forward, looking at the Secure Act, which was a provision that was passed in 2019, and again, some additional tax laws that were passed. Some opportunistic, some not so opportunistic. The key provisions that affected individuals were eliminating the age for making traditional IRA contributions. So prior to the Secure Act, if you were less than 70 and a half, or if you're over 70 and a half, you couldn't make traditional IRA contributions. So the Secure Act eliminated that. So if you're over 70 and still working, you can continue to make traditional IRA contributions, and that's either deductible or non-deductible. And the reason I point that out is because utilizing a non-deductible IRA, you could utilize the backdoor Roth provisions, which are still in place. They also raised the required minimum distribution age to age 72. So prior to the Secure Act, it was 70 and a half. You had to start taking money out of your IRAs, and a little bit each year, depending upon your age. It's based upon a life expectancy factor table. So still have the RMD, but the age requirement was raised to 72. They allow a $5,000 lifetime penalty-free distributions for birth or adoption. Again, that's a new provision that was added. Eliminate the stretch IRA provision. And this is probably the biggest planning point that I've been talking with folks around the Secure Act. Prior to the Secure Act, if you were a non-spouse beneficiary who had inherited an IRA, like those over 70 and a half, you would have to take a required distribution every year that was based upon your life expectancy. So again, as a child inherits an IRA from a mother or father, he would have to take a little bit each year based upon that life expectancy factor table, but you could stretch out the IRA over the course of your lifetime. So mechanically, you're only taking out a little bit year over year. The new rule forces you to have that same IRA zeroed out within 10 years. So for individuals with large IRA balances, there is a planning opportunity there, kind of looking at brackets. Does it make more sense to start whittling down the IRA over your lifetime at your tax rates, or to pass them to your kids where they would have a 10-year period to take them out at their rates, which may be forcibly higher because of those distributions. So again, there is some planning opportunities there around that elimination of the stretch IRA provision. And so we went from Secure Act to the CARES Act. Brent, I don't know if you comment on this one.
I really don't want to. It's more of a stroll down memory lane. Just to go back to the Secure Act real quick, I think the CPAs were all geared. This was passed in December of 19, and everybody was geared to look at this. And there's a lot of meat in this slide, and unfortunately, we're not going to unpack it today as much as I had hoped that we would have in January. But this actually ended up by necessity getting ignored, because then the pandemic hit, and life as we knew it was over. So again, there's a lot that changed here, and there's a little bit of meat on this slide that I would encourage you to maybe talk to your advisor as well. And I'm sure Chuck has looked at his client base and has handled them accordingly. So so the Families First Act, Chuck, the next slide, I really don't have much to say here. It's just more of a stroll down memory lane. This came to be in March, and the gist of this, as we know, was every employer had to now offer, if you want to call it offer, sick or family leave time for employees that had COVID responsibilities. So even if you had one part-time employee, they had some family leave that they were entitled to. And I think everybody got their head around this. And in terms of this, I believe it went through December 31st. I have not heard of any extension of this act. But I did have, again, a client just emailed me yesterday that they had a situation. And I think that, you know, we have a couple weeks here left in December, you know, that they have to offer that paid leave to their employee. Now they get reimbursed by reduced tax credits on their payroll returns. But again, in essence, the employee has family leave rights, if you will. So.
All right. So along with the CARES, the Family First Act, the CARES Act, which was passed, the Coronavirus Relief Act, back in March or April, afforded everyone or who qualified a $1,200 recovery rebate, which is people known as stimulus. So if you got a stimulus check, that's what that's referring to. Unemployment benefits were expanded. Again, on the investment side, there was a waiver of required minimum distributions for this year. So if you're over, again, 72, normally you'd have to take a distribution. This year they waived that, mainly because the market, we went through basically 2 market cycles in 9 months here. So back in April when things were down, they didn't want to force people to have to take money out of retirement accounts if they didn't have to. And then the other change is the waiver of a penalty for qualified early distributions of retirement accounts. And there's actually a lot to unpack with this one. So for this year, if you have a coronavirus, if you're affected by the coronavirus, and there's I think 5 exemptions or definitions for what that means. And it's kind of a liberal thing. You can access retirement dollars, so IRAs, potentially 401ks, without paying a 10% penalty. And you can also defer the income that you take for over a 3-year period. And you can pay that back within 3 years if you amend your returns, and you can get the money, the taxes that you paid back by filing an amended return. So if you think that if you think you were affected by the coronavirus, whether you tested positive or you were adversely affected from a financial standpoint, income was down, it would be a good idea to kind of look and see if you would qualify for this provision. For 401k plans, there had to be to access a 401k account. There had to be you actually had to have it in the plan. So you had to make an amendment to the plan to add these sort of distributions within the plan. So we were working with a lot of our 401k providers this year and adding these amendments. Generally, most providers weren't charging for them, but you did have to actually go in and file to have this amendment in the plan. So, you know, if you have the 401k plan and it has the amendment provision in there for coronavirus related distributions, you may be able to access those funds, defer the income over the next 3 years, and then potentially pay it back. And if you if you couple this with the idea that taxes may be going up down the road, it's certainly, you know, affords the opportunity to play the brackets a little bit. So if you know you're going to be in a lower income tax bracket this year, either because the brackets are lower than they are going to be in the future, or if you're looking at retirement down the road or higher income down the road, then it may make sense to kind of increase distributions now. There were also plan loan provisions allowable for increased loan limits. So old rules, prior to the coronavirus, you could take 50% of your 401k balance up to $25,000 as a plan loan. They've increased that to $100,000 or 100% of your vested account balance. And they also allowed for 1 year delayed repayments of 401k plan loans. So again, that's another way to access your funds the plans do have to have these amendments in place, so it's not available to everyone. But if your 401k does have it, and you're thinking that you might need access to funds, there are ways that this may have helped you. So that's on the individual side of things. Brent, you want to talk? Is there anything you need to add to that? Again, there's a lot that.
No, I was just going to say, I think everybody now understands how important or how nice it is to have Chuck Porter and Brent Thompson under the same roof. I think you just did a really great job showing how well we as, advisors have to work together for our clients. So I apologize. I meant to stop a little sooner. There was a question that came in, and they were asking if the personal exemption to be restored as well on the individual returns. I don't know. I haven't heard. I haven't read anything about that. So I'm going to gather to say they would not come back, but that is just my guess based on my reading and research. So
yeah, I have seen the salt limitations removed. I've seen that as part of the proposals. So there's a $10,000 limit on the SALT deductions, but nothing on personal exemptions.
Right. Yeah. So the business provisions, really quick. We're all aware of the PPP program, at least the business owners are. We've had, I think, 4 of these programs on just the PPP program. There's employee retention credits and delay of employer payroll taxes that we've also covered in those presentations. There's modification of business losses in terms of carrybacks, forwards, amounts, and there was a technical correction of depreciation for property that was placed in service previous. So again, the business provisions here, and a increase in the interest deduction limitation, which I don't know would affect any of our current clients, but not to brush over this slide, but we literally have 4 programs on this stuff. So again, I'm just taking a trip down memory lane here. So.
All right. So we've went through Tax Cut Jobs Act, Secure Act, CARES Act. Now we get into the Biden tax plans and some of the stated provisions that we've seen on his website and other publications. A lot of this stuff is tax credits. So a lot of stated tax credits, expanded child tax credits up from $3,600 per child from 2000. That 2000 was actually doubled prior as part of the Tax Cuts and Jobs Act. So this would almost be a doubling of that as well. Expand Obamacare premium tax credits. So reintroduction of the individual mandate. Again, Brandon talked about kind of how that affected families and what it meant. Family cost capped at 8.5% of income. So again, potentially capping the cost of insurance. Brent, that's correct, right? And that's what that would refer to.
Correct. Yeah.
Introduction of child tax credits for childcare, expanding from 8,000 or from 6,000 to 8,000. This is a new provision: tax credits for costs to families taking care of aging loved ones. This is also folks with disabilities or military veterans. I saw as well as another provision. So if you're taking care of a wounded vet, so that's a new one. I've seen a $5,000 tax credit that was floated there. Tax credits for first-time home buyers. This is a new provision as well, up to $15,000. I've seen this being specifically stated for families who rehab houses in distressed communities. But expanding tax credits for first-time home buyers seems to be something that's on the agenda as well. Equalizing the tax of retirement plans. Again, this is one we have a whole slide dedicated to this. What they're proposing is they're going to try to. It sounds like they're going to try to equalize the amount of tax benefit that folks would receive, whether they're high income or low income. So right now, you put money into 401k accounts and you essentially get a pre-tax deduction for it, so it comes tax-free, goes into those accounts, which sort of disproportionately may benefit higher wage earner higher wage earners who are able to put in more into these plans. Again, it's from where I stand, it's an incentive for folks who are starting these plans. Certainly can get more of a tax benefit, but for folks who are looking to start these plans, it's a benefit to them. So I think it would make some sense to keep that in place. I don't know how much legs this will get. I think the more that you unpack, it would be, so what they would do is take it from a deduction to a flat credit. And I don't know, Brent, if you want to speak on any of this, on any of that at all. I mean, I've seen it, a $4,000 credit would be the amount that's been floated.
Yeah, I agree with you fully. I don't know how much legs this will grow. This is really a lot of this, which we'll get into with the estate and step up and stuff, would just be, I don't want to say earth shattering, but I'm trying to come up with a term, but it would just be a very, very big change. And I'm not sure that it will pass. I will say, I'm going to throw in a little bit of an opinion here, right, wrong, or indifferent, but personally, I'm not a huge fan of credits. I mean, if we go back to the previous slide, you know, tax law should be used to stimulate something. So for instance, if you take the first-time home buyers credit, you know, up to 15,000. Well, does first-time home buyers, does the housing industry need stimulus right now? You know, and who's going to take that away? You know, education credits, you know, yeah, these are hard costs for families, but do we need to stimulate more people going to college through a tax credit? You know, and just throwing out credits for children and daycare and stuff, you know. Some of them, adoption credit, in full disclosure, I've used that. But again, we could argue that one maybe takes a burden off the government. So, but again, once these things are out there, neither party, no certain person's going to take them away. And, you know, they're really ripe for fraud, especially the refundable credits is, you know, just really ripe for fraud. One of my favorite stories, real quick, is a Jackson Hewitt franchise. I think somewhere out in the Midwest, there was an individual that had a number of these franchises, and they just went crazy with claiming credits. One of the credits is for use for off-road fuel, and you're paying taxes, but if you're not using the roads, if you're putting it in a tractor or, you know, some piece of machinery that's not using on the road, they give you a credit for the taxes that were on that gallon for quote unquote road use, if you will. So they were claiming off-road fuel credits for professionals like a barber, okay? And not just a little bit, like 25,000 gallons worth of off-road fuel. You know, and the IRS calculated he needed to drive like 1,370 miles per day for 365 days, you know. Babysitters, they were claiming 37,000 gallons for a babysitter, you know. These are the stupid people that are out there, you know. It's really crazy, but these credits, again, to point it out, are really ripe for fraud. So.
Yeah, and you know, equalizing tax benefits of retirement plans is something that be just a dramatic change, and I just, again, I've seen some scenarios where, you know, if someone who's in a higher tax bracket, who was maximizing under the old plan, could potentially earn as much as $9,000 in tax savings from utilizing the 401k plans. Again, and a lot of these folks who are in that position are sponsoring these plans, so there's a cost to them, and so there's, I hate to say it, you know, there has to be a reason for them to sponsor these plans for their employees, and under the new plans, that same contribution would limit them to $3,600 in tax benefits. So again, I don't know how much that will, whether that will get legs or not, but it's certainly something that we're keeping an eye on. And the financial transactions tax is also something that's I think it's been on the table for a while. I don't know if that'll get legs as well, but keep an eye on it. All right. Again, a lot of what we've seen, this is from the Tax Foundation in recent weeks and months, would be the provisions. A lot of the major changes, major tax revenue generating changes would affect higher wage earning individuals, so over $400,000 in income, raising the individual rates, raising the payroll taxes. So right now there's a cap on how much, your income reaches a certain point and you stop paying payroll taxes. So eliminating that cap is on the table as well. Raising capital gain rates to ordinary income rates for those over $1 million in income, where so 20% could become 39.6%. And that seems to be a high number, that $1 million in income. But I will say, when you start factoring in, business transitions and low basis assets, and we'll kind of get back to this on the estate side, $1 million in income is certainly not out of the realm of possibility if this is combined with some of the other changes that they're proposing on the estate and gift side. So cap itemized deductions at 28% benefit. So reintroduction of the alternative minimum taxes in play. New phase outs for 199A deductions for those over 400 in income. So a lot of these are, again, we've talked about. The number one tax revenue generator from the taxfoundation.org is raising the corporate tax rates back from 21% back to 28%, implement a minimum book tax on $100 million in income and up. Again, that's on the business side. On the estate and gift tax side, eliminate the step up in basis for capital gains taxation. This is a huge change, potentially a huge change, something we're keeping a very close eye on. Right now in the current environment, you pass away, you pass your asset to your child, they would get a step up in basis as of your date of death. So think about, businesses, beach houses, low basis assets. You have $1 million beach house, you paid $250,000 for. In the current rule, you would be able to step up the value for the basis for capital gains sales to $1 million. So if you sold that beach house, if the kids either had to sell it or just had no reason to want to keep it, they could sell that house and essentially pay no capital gains on it. If this goes through, they would now be on the hook for $750,000 in capital gains. So, and again, you combine that with the raising capital gain rates on an ordinary income for $1 million and up, you're at $750,000 right there. Deemed sale of assets at death, return to 2009 levels for estate and gift tax exclusions. Current law, you can have an estate at about $20 million. And if your estate is below $20 million, then you don't have to worry about federal estate taxes, which start at 40%. This would revert those levels back to 2009. That's what's kind of been floated out there, which would bring it back to $3.5 million of an estate exclusion. So again, that's a much lower number with a very painful tax on the other side. So there's also been I don't know if this is coming, if this would be in any future slides, is treating gifting as a deemed capital gains transaction. So right now, if you are to gift assets to a child, which you kind of navigate, how do you navigate the estate tax rules? You can utilize gifting, so you can gift low basis assets, try to keep your estate below those thresholds. It has been floated that transaction could trigger a capital gain event. So now you could be facing the possibility of paying capital gains on a gift to a child, which would change the game rather dramatically. So again, that's a lot of stuff we're keeping an eye on.
do you mind if I unpack this slide a little bit with you
Yeah,
as
absolutely.
well?
Absolutely.
So a couple things is, we're left with, the possibility of taxes going up. And the dilemma right now is not a good one at all. We could act now, and it could be something very costly that turns out to be unnecessary if something passes, or we don't act and we have a possibility of being costly because we missed out. It's really not a good situation at all. That third bullet point from the top, the 1 million that Chuck said, we're going to unpack that a little bit in the coming slides. And the step up in basis and stuff we'll talk about a little bit. But we talked about the Georgia Senate races and how that's going to affect. But even for the sake of conversation, let's say both Republicans win and we're left with a split, as far in that direction as we can go. Understand, I'm not an expert, but all this could potentially pass with budget reconciliation regardless. And what does that mean? If something is budget neutral, that is, you offset the increases and the decreases, you can pass with 51 votes, okay, versus 60 that it would take to pass a law that actually dissaves or spends money, if you will. So even if, again, both Republicans win, they just need a couple defectors to go over to some kind of tax package to get this passed potentially under reconciliation. So again, it depends how those races turn out a little bit, but not entirely. So just to kind of put an example together, if you will, of the dilemma that we're facing. So right now, if your capital gains rate is 20%, and you have that significant asset that's going to put you over the million, if you will. Right now, your capital gains rate's 20%. That could bump up to 39.6% overnight. So do we want to do something now? If we do something now, you'll pay 20% capital gains. You might have the net investment income tax. You'll have Pennsylvania 3.07. So if you add them up, you're at just under 27%. So if you have, just use easy math, $100,000 asset, I'm asking you to plan and pay $27,000 in taxes. That's really a tough pill to swallow. But if we don't do anything, you could be left with a 47% tax bill if this stuff passes. And again, it could be retroactive to January 1st, even if it passes in June, July, August, or whatever of next year. So again, that's the dilemma that we're talking. Now, even if you're out there and you're saying, okay, my income's under 400,000, I don't have $1 million or whatever. Again, we went back and discussed some of this Tax Cuts and Jobs Act because you'll be affected one way or another with the corporate raising of the rates and that minimum book tax of on corporations with 100 million of income or more. I can tell you as a CPA, every client I go to says, I don't really care because I just pass my cost on to my customers. So who's the customer of a $100 million company? AT&T Wireless? That's me, right? So my cell phone bill goes up, right? If they have to pay 21 to 28, my cell phone bill goes up, So again, all this will affect pretty much everybody across the board, whether it's, directly or indirectly. So, so we have some real tough situations here. So thanks, Chuck. I just wanted to, again, just kind of unpack that from the CPA side a little bit.
Yeah, I know it's a challenging situation we're dealing with, sure, and a lot of this stuff, inevitably it would be great to be able to act on some of this stuff now while we know what the rules are and while we understand that we're sort of in a favorable spot. At least we think we are, but mechanically it's really hard, right? I mean, we're in this environment where face-to-face meetings aren't happening. Or if they, they're on a limited basis. And so a lot of this stuff is hard to implement, right?
We
So
have one dog that made an appearance today.
yeah.
I do want to say one other thing real quick. So I'm not an estate or a gift tax expert here. I play one as best as I can at times, but if we're jumping the estate tax exemption down to 3.5 million, understand right now, again, it's up, 11.5 or so per person with portability, meaning if you're married, you're at, 22, 23 million. So only, I think, like 10% of households are affected by federal estate taxes right now. If that goes down to 3.5 million and everything is going to be a deemed sale upon death, we could be in a world of hurt in that. Let's suppose you're a single person, you have, a $10 million estate. You can't gift away 8 and say, I'm going to live on 2, because then when you pass, when you die, if the exemption's 3.5, you've already used that by your $8 million gift. So the 2 million that you're left with is fully taxable. Well, again, if that 2 million is fully taxable upon death, it depends what that asset is. If it's a business that has no liquidity, we're going to return overnight to the days where the surviving family had to sell the assets to pay tax. And your family business may not be your family business at that point, So this is really, really could be very dramatic changes, very, very dramatic changes. Again, if it goes deemed sale upon death, right now the incentive is to hold assets and pass them through the estate, because you do get that basis increase through the estate. So your heirs inherit it at a higher basis. But if that goes away, we're absolutely making a 180-degree shift, and now all the incentive is to gift stuff out prior to death. So again, these could be very, very big landscape shifts here. So
Yep. And this is the second biggest tax revenue generator according to the Tax Foundation, and the third would be the elimination of the step up in basis. So you mean the three biggest changes in terms of where they're getting the money from to pay for a lot of these credits are your corporate tax rate, the raising the payroll taxes, and the step up in basis elimination. So we talked. I mean, do you want to speak briefly about the raising the payroll taxes?
So the proposal, just real simply, if you're a business owner, I think you follow this. The Social Security has a base on it. I believe in 2021, yeah, it's right on the slide, 142.8. So once you achieve 142.8 in taxable wages for Social Security, that tax stops being withheld. But the proposal out there right now is to bring it back on wages in excess of 400,000. So there's going to be this what's called a donut hole between 142.8 and 400,000 where you don't have that withholding. And again, this is just what is being floated around until it goes through the meat grinding process, and what comes out on the other end, I don't know, but this is floating around a little bit. So we'll have to watch this.
Yeah, I would think this is likely in some regard. I mean, maybe it's, maybe they just increased the current limit, but I would think this is something that will get some some support.
Yeah, Social Security is another subject altogether, but that being said, I would expect this has had potential legs for
Yeah.
decades, I would say, in some respect. So, all right, so I guess I'm doing business planning here. So the ideas right now is, since you have that donut hole, for S corporations, if you're paying yourself in excess of 400,000, you may want to consider doing distributions instead of the wages, assuming that, again, the donut hole is retained. The second bullet point, I'm not going to unpack too much because we really can't do anything, and I wouldn't advocate doing anything before a actual tax law is passed. But the point is, we may want to think entity election or conversion. And that's a huge, huge undertaking, evaluation, and you can't do it lightly. I mean, it's not like you get to choose an entity every year that you're in business, right? These are supposed to be ultra long-term decisions, but I just trying to plant the seed that once the law is passed, that's on the table, to look and see, is another entity better going forward. And then there's also deferred compensation plans you can consider if you're over 400,000, or for whatever other planning reasons may be. Deferred compensation plans, by implementing one of them, you can spread your wages out over time instead of having them all lumped together, and possibly take advantage of that donut hole that does exist. So I think they're going to become more popular as we go forward here, especially if something passes to that effect. So these are a little bit more generic, but again, considering potential tax law changes, they've become a little bit more relevant this year. So again, you may want to consider paying bonuses this year if that would potentially excel income, if that's beneficial. Collection of receivables if you're on the cash basis. And then also we do have the potential to accelerate or delay depreciation. We can do that after the fact as CPAs, the first couple not so much. But again, this slide's a little bit generic, but I want to sort of just make the point, I think, with the generic slide is, especially if you're in the lower bracket or that taxes are going up, I always advise my clients in those situations, to accelerate income and pay more taxes. Especially in the lower, the 10 or 15% brackets, I would always try and max them out one way or another. And Chuck and I can work together through, harvesting gains, which we'll get into in a minute, with investments, or taking some kind of accelerated distributions from plans or something like that. We'll get into the individuals in a second. But, taxes 10, 15%, you're not going to do better than 10, let's put it that way. And 15 is probably reasonable. So what's the alternative in the future is 25, 28, 32, I always want to take advantage of the 10 to 15% bracket, especially if you're somebody with a decent income throughout your working career. You'll have Social Security, you might have some investments spitting out interest and dividends and distributions and stuff like that. It's pension, required IRA distributions. It may not be hard in the future to get up to 100,000 of income. at all, so you'll have some tax. You'll be in a bracket. It's not like when you retire, you automatically go into a 0% bracket. So we have to keep that in mind. And if you're in those brackets for whatever reason this year, even though things are tight or whatever, we have to evaluate that. But, it's not always Excel expenses delay income, so I pay less. Sometimes it does make sense to pay more. The other, this is probably not relevant, but it is out there. If you have sold an asset or in the process by the end of the year, you can consider using an installment method. You can spread the tax out if nothing changes. If it does, you can make a tax election to pay up front for the future years of income. So you'll actually have until September 15th in the case of an entity return, or October 15th of 2021 to make that decision technically, because you would do that with your tax return. So if by chance you're selling something by the end of the year and you can get that in, that would be a good planning point as well. So, okay, Chuck.
All right. Key individual, and this is kind of dovetailing off of the same stuff that Brent was just saying. If we anticipate that taxes are going to go up and that things are going to get less favorable down the road, we may want to consider accelerating income and delaying deductions. So Roth conversions, so taking traditional IRAs, traditional retirement accounts, and converting them to Roth certainly seems like something that should be considered. And again, if you couple this with the elimination of the stretch IRA provisions for non-spouse beneficiaries, where they now have that 10-year window to take money out. So if you have the money in the Roth and you've paid the taxes on it, then that doesn't matter, right? There's no tax implications to them. So you've paid the tax at your rate rather than them paying the tax at their rate down the road. So again, it's definitely something to consider. It would be nice if we have these rules in place for next year, because then we get a little bit more time to plan and implement some of this stuff. But that's definitely something to consider. Gain harvesting at 20% rather than a potential 39.6%. So if you're in a situation where there's an asset there, low basis asset that could push you or your beneficiaries up over that 1 million mark, it's how do we handle that? Well, how do we plan for that? So that's a really important thing to look at. Key point: there are no wash sale rules with gains. So with losses, you have to wait 60 days before you can repurchase. That doesn't exist with gains. So if you wanted to take capital gains now, you could turn around and repurchase the asset, reset the basis. You've harvested the gains. You'll pay taxes on the gains. But you're paying taxes on what we perceive could be a lower tax rate. So it's definitely something worth considering. Defer loss harvesting. Again, this is probably contrary to what all the planning that we've done, where, we're looking for ways to harvest losses. It's now you're looking for ways to defer those losses potentially. So you can kind of stack them down the road when you think you might need them. So that's definitely something worth considering. Deferring charitable giving and other deductions. So again, it's you're finding ways to reduce your income, especially for folks who may think that they're going to be over 400,000. You have to try to find ways to stay below that threshold, because that seems to be the mark where a lot of these provisions have been targeted. So there is a 28% limitation that's been floated on itemized deductions. So it's important to kind of factor that into your equations as well. So, if you're deferring deductions and then you're over the 28% threshold, then you're sort of losing the benefit that you think you would have gotten. So, and again, this is all predicated upon what we know being passed, which is not 100% certain, but it's looking at your deductions, kind of figuring out what you can push out and what might make sense. I would think the SALT limit, that seems to be something that's out there that could be repealed. We've been using donor advised funds quite a bit over the past couple years to take advantage of the higher standard tax deduction. So the idea has been we would front load charitable contributions. So if we have a client who's putting $10,000 in, maybe that's not enough to get them over the standard deduction threshold. We've been front loading, future years worth into a donor advised fund they would use that fund to essentially pay out their future years charitable contributions, but they would give themselves the opportunity to get a tax benefit in the year that they make the contribution. So bunching deductions, bunching charitable contributions in the year that makes sense. So this will be an offshoot of that. It's, if down the road the tax rates go up and you're looking at a situation where you think you're going to be negatively impacted by where you're at from a tax standpoint, it's utilizing a donor advised fund, bunching charitable contributions when you can.
Yeah, Chuck, can I just do 3 comments real quick here?
Yep.
That SALT deduction, the state and local tax, the itemized deduction, $10,000 limit, that's a real thorn in the Democrat side. So I would fully expect that to be repealed in anything. They don't like that at all. And, so the game harvesting, that's a really great idea, but I'm thinking off the top of my head, if you do have a large loss carryover, you wouldn't be able to do it necessarily, or I wouldn't advise to do it because that loss in future years could be worth more than it is this year,
Makes sense. Yep.
So, and again, we're talking about accelerating income or delaying deductions. If the reverse is true, if you want to delay income and accelerate deductions, I guess you listen to this backwards or upside down or something. These things go either way, but but I think in just trying to plant the seed that, we may do some traditional planning here. So go ahead.
Yep. Other accelerating income delaying deductions we talked about, exercising stock options now, especially if exercising those options would put you over that $400,000 mark. And again, this has been talking with a lot of clients about these required minimum distributions. So you don't have to take them this year, but it might make sense to do so. Again, we don't know where the tax brackets are going to go if they eliminate and go back to the the pre-TCJA tax brackets. Then there could be a reintroduction of a 15% bracket, which might hurt folks, or those 28% brackets. There's a decent window in that 24% range, which it really makes, which has been really valuable for clients over the past couple years. So kind of understanding where you're at, and even if you don't need to take income, if it makes sense, try to get it done before year end if possible. And again, this is the big one. And I put a whole slide, moved this back, and wanted to just kind of unpack it, just make sure we really understand. Estate planning it seems to be the biggest, the biggest target, the biggest bullseye is on estate planning. And so making sure that, you understand where you're at and what might be coming, reevaluate your estate plans. Understand low basis assets and how they might be treated moving forward, and try to come up with a plan to transfer them. If you have a business, think about getting evaluations sooner rather than later, and think about how you would transfer those assets, transition those assets, so that your estate isn't forced to sell something in order to come up with the taxes that might be owed in a deemed sale. So again, there's a lot of stuff to unpack, but I think estate planning is going to be huge. And again, you combine all this stuff with the $3.5 million exemption on the state, the exemption on the estates dropping from 10 million to 3.5 million. There's just a lot of major pitfalls that you could fall into if you're not planning. So gifting, I've been doing a lot of year-end gifting for clients. We know what the rules are now, try to transition assets now in a favorable environment. So, low basis stock, things of that nature. Again, this is what I was talking about. The new law could make gifting a recognition event. As of now, there's no. Brett, do you want to comment on this? There's no guidance. There's an income tax deduction or such for estate taxes paid.
Yeah, I mean, normally you'd get a deduction, but for now, there's no guidance in this plan of an indication of one way or another. So,
Okay.
but again, this whole thing's going to be a major shift if it goes through. We're going to be gifting every year is going to be a strategy, or at least a sale to try and keep those assets under $1 million capital gain per year. So I would say before I get into this, just to remind you, if you have any questions, just go ahead and chat them to me or to Chuck, and we'll get them. I am going to literally go through, I'm going to try and do this as quickly as I can, just a PPP update. And the pending legislation that could be passed any minute here, and literally any minute. Something could be passed while we're on the presentation here, and I think we had that actually in April. So if we keep our streak alive, the presentations would be obsolete as soon as we're finished. So so we'll see what happens. But this is as of 4 o'clock yesterday. So recent stories you may have heard prior to this week. The Republicans had a bill. It was like $500 billion, but they didn't want to give state or local governments aid necessarily. The Democrats had a $1.4 trillion bill, but they didn't want to give COVID-related liability protection for businesses. They all had names and everything, and then, but they couldn't. The point was they're far apart on dollars and principles, if you will, lack of better term. The recent stories this week, you may have seen a $908 billion bill, but that, as of yesterday, is down to 748. It's a 525-page bill right now. I will not say that I have read 525 pages, but it is, my understanding is it's out there. If you have an interest, if you do, please let me know, and I'd like to make a job offer to you. But there really is crazy pressure. And what I'm seeing this morning, I did look for an update, is they're really looking to do something possibly this weekend, if not any minute. So next slide, Chuck. Part of the COVID relief that's trying to be passed is another round of PPP. And this is some other stuff that's included. I'm not going to go through the bullet points here. Just the second one is, $300 billion right now would be allocated for a second round of PPP loans. So the other, you'll see that is pretty much an extension of a lot of stuff under the original CARES Act. I don't know that there's anything new, but there could be, but nothing else really stood out to me. So next slide. So as far as we know right now, the verbiage included in the bill, and again, this is 4 o'clock yesterday, there was a simplified loan forgiveness for both the first and second round, I believe. For $150,000 loans or less, would boil down to a one-page form where you would just have to attest to complying with the requirements. So again, we are looking forward to that. We've held off applying for a lot of forgiveness because of the burden that it is, to be quite frank. There's a lot of calculations and a lot of stuff that goes into it. So right now, you may be aware that there is simplified forgiveness they've done for under $50,000. The IRS could do that. Treasury could do that without a law passage, deeming it de minimis, again, for a lack of better term. But there would be actual legislation now to bump it up to $150,000. So we're hoping that would take care of the vast majority of loans throughout the U.S. I don't have statistics, but it would be a good portion of them. I should say I don't have them handy. There would also be some other tiered loan forgiveness simplification for under 2 million, where you don't actually have to submit the documentations. I envision you have to submit the calculation results, if you will, and go through all the hoops. You just don't have to give the bank, I mean, all the papers, and it is a little bit of a burden right now. So that would be much welcomed by everybody as well. So the other part of the CARES Act was the SBA made payments on anybody that had a 7A loan, a business loan, mortgage, if you will. They made 6 payments during the year, and they are looking to extend that as well. I don't have anything in front of me in terms of the length, but again, they'll put some funding there. They'll have more of the emergency disaster loans and a special grants for other venues. If you're a theater, a museum, or something that is just absolutely shuttered and closed, there'll be special grants in there as well. All right, next slide. I'm trying to cruise through here. There's going to be a second round of PPP. Again, there's going to be 2 eligible groups. The first-time borrowers would be any business that has the North American code starting with 72, which is accommodation or food services. They're going to let them go with 500 or fewer employees. Nonprofits, including churches, can borrow again. And here's the new one, is 501c6s, which are Chamber of Commerce, and I forget what other verbiage, like destination something or other, but mostly Chamber of Commerce's here would be affected. 150 or fewer employees. Lobbying activities would have to be a de minimis 10% of receipts or 10% of activities here. And there could be other criteria as well. So go ahead, Chuck. The second group that would be eligible would be a second draw. So you've got PPP 1. So you would be eligible for PPP 2, 300 or fewer employees. And right now, again, the verbiage is a 30% gross receipts decline in any quarter of 2020 compared to 2019. And that is a calendar quarter right now, not a 3-month period. Again, all this is subject to change. It's the verbiage that was out there yesterday, end of day. And a possible tiered system of certification in the application process. So that is the smaller loans won't have to jump through all the hoops that the larger loans will as well, in terms of submitting documentation in the loan process. So go ahead, Chuck. Okay. PPP 2, the maximum loan amount is not 10 million. It will be bumped down to 2 million. It is still factored at 2.5 times your average monthly payroll cost. You will have a choice again of an 8 or a 24-week covered period. And the cost eligible for forgiveness are the same as PPP 1, but they're throwing in worker protection expenses, that is PPE cost, and cost to comply with government mandates. They're throwing in supplier cost, and it just seems to be generic right now, is what I could tell. So whatever is quote unquote essential to current operations. So I would assume purchases, goods, cost of goods sold type of cost. If you have a service business, I'm not sure that there is a supplier cost, but again, it's very generic. I'd have to look at the wording when it does pass. For some reason, it adds software cloud computing services, and the PPP2 would keep the 60-40 ratio of payroll, non-payroll. So, All right, real quick, the timing of this legislation, like I said, by the time we get off here, it may have passed and we're already obsolete, but what we're probably looking at, what I saw this morning is over the weekend, there's a lot of moving parts. There's a potential government shutdown at the end of the day today. There was one last week and they passed a 7-day period to extend to this week, this Friday. I would say that that's, again, if they pass another short continuing resolution to get through next week, I would not take that as a bad sign. I would take that as, you know, they're staying in town over the weekend and, you know, trying to get something done. Again, there's tremendous pressure. There's the relief package, which is, again, interwoven with the government shutdown. And there's also an unrelated defense bill out there that is also floating around. And they're trying to take care of these three things. They all have to get past both houses up to the president to sign the defense bill. I believe certain Republicans are encouraged the president to veto it. So that would have to go back for a veto vote to override the veto, stuff like that. So there's a lot of stuff going on right now in Washington. So if it does pass sometime today, tomorrow, Monday or so, best guess would be the funding would be available early January. You know, all the initial framework is there. I think if I'm not mistaken, PPP1 was available within 2 weeks of the passage. However, you know, all the framework is somewhat built out already, but I just think with the holidays, we're probably looking at extremely early in January. So, okay. Next slide. Book and financial accounting, really quick. Financial accounting and book accounting, these PPP loans are loans. There are some options to treat them as grants and some other things, but most companies by far are just handling it via traditional debt model. That is, it's on the books as a loan payable. It should show as a liability until it is actually forgiven. Once it is forgiven through the books, it will go into a gain on extinguishment of debt category of other income, if you will. And then it would get wiped off the books that way. All right, so for book purposes right now, it's a liability. It's sitting there, nothing's happening because nothing's due yet until some point in 2021 at the earliest. So if it's forgiven, if you have applied, I believe the last statistic is, I think only 5% of businesses applied for forgiveness so far. And I'll throw that out. I'll get into that in a second on the next slide, why that is so low. Excuse me, but if you have had it forgiven, then post it to a gain on extinguishment or other income or something on your income statement to get it off the books. All right, the tax accounting, the next slide, Chuck, is a little bit different. So the conventional, just to go back and back up a little bit. So Congress said that the forgiveness is not a taxable event. All right, so the forgiveness of the loan would not be taxable. However, there was an existing law on the books, and I'm not one to defend the IRS, but this seems fairly black and white. There was an existing law that said any expenses paid with certain types of tax-free income are not deductible. All right, the forgiveness of these PPP loans fit into that certain type of other non-taxable income. So in essence, the payroll and the other expenses that you've paid, excuse me, with the loan proceeds, those expenses are not deductible. And what happens when you can't deduct an expense, your taxable income goes up, right? So in essence, through a backdoor, it was taxable when forgiven. And that was back in May or June, I believe. So the conventional wisdom between June and a couple of weeks ago was, okay, well, it's not really tax-free income until it's forgiven, right? Because it is a loan right now. There's a loan note there. It's on the books as a liability. There's repayment terms. There's every element of a loan. And if it's not forgiven, then it's not tax-free income. So the conventional wisdom was to apply for forgiveness early January and have it forgiven in 2021 and deal with it then, okay, which would give Congress time, because Congress is really upset because they intended to not have tax consequences to this at all. The IRS came out a couple of weeks ago and said, and you can look back, we sent a constant contact email out, but they basically said, even if you don't apply for forgiveness until 2021, if you reasonably expect it to be forgiven, then you have to pick it up as non-deductible expenses in 2020, regardless. So that turned the conventional wisdom on its head. And that's why so little people were applying for forgiveness to date, is they were trying to push the impact off and let Congress deal with it before you file 2021 returns. As of right now, the deductibility wording is included in the current draft legislation. So, and they're really fighting hard for this. One last point, and I see we're a couple minutes over, and I apologize again for starting late, but my last point for today is the 7A subsidy payments that the SBA made on mortgages and stuff. The IRS has not issued specific guidance on them yet. However, in the past disasters, the IRS has ruled other government assistance programs, not this particularly, but other programs, were taxable because the taxpayer had access or gained wealth from those programs. But the IRS does have some options to exclude the subsidies from income without specific legislation being passed. So we're waiting on the IRS to make a decision one way or the other. For my clients, I have not included the PPP forgivenesses in my projections. That's just me. I could be wrong. Don't take that to the bank and argue with anybody on that. If I'm doing projections for clients that have the 7A subsidies, I would probably include them a little bit more. So, but that's not a given either. I think with the overall, understand the previous disasters were more local than this quote unquote national disaster. So this could be very different. So Chuck, I will turn it back over to you and we can wrap up.
Yeah, I don't know if any questions came in to you. I don't see any on my side, but obviously there's a ton to unpack here. And I know, I hope that you guys saw something today that maybe made you think that you need to act. That's really where we're at. I mean, we're not sure what things are going to look like down the road, but there's enough there to say that these potential changes are going to impact just about everybody. So, so if you think you need help, if you'd like to chat with someone about your situation specifically, come find us. We're more than happy to schedule time to Zoom or hopefully sit down when this thing clears. So.
Yeah, and I would just add, again, I've asked for this over the past couple times. We've put the time in here to do this presentation. If I could ask you to literally take 2 minutes and leave us a review on Google, or you can follow us on Facebook and stuff like that as well. But if you could please just take a couple minutes in exchange for our time. And the last item there is we are hiring. So if anybody knows of, and I say we over in the CPA area, if anybody knows of anybody with literally just out of school to 10 years of experience or under that is looking or would like to explore some possibilities, we would be very interested in speaking with them. So I would like to throw that out to the group as well. So.
Very good.
Okay. All right. So if there's nothing else, I don't have any questions. So if there's nothing else, again, we appreciate your time. And again, please don't hesitate to reach out. So thank you, everybody.
Thank you.